In August 2019, a group of lawyers acting for a company called the We Company transmitted a 300-page document to the Securities and Exchange Commission. It was a registration statement, the routine paperwork every company files before selling shares to the public. It contained no crime. It revealed no hidden fraud. It disclosed nothing that the company's own investors had not known for years. And within 6 weeks of its publication, the most valuable startup in the United States had lost $40 billion in value, fired its founder, and abandoned the offering entirely. The founder was Adam Neumann. The company was WeWork. 8 months earlier, it had been valued at $47 billion, the highest figure ever assigned to an American startup backed by venture capital. By the end of September, it would be worth less than $8 billion. Neumann would be gone, holding an exit package reported at up to $1.7 billion, while the company he built lurched toward a bankruptcy that arrived 4 years later. That document, filed on a Wednesday in the middle of August, was the moment WeWork began to die. And the strangest part of the story is that it died not because the document lied, but because, for the first time, it told the truth to the wrong audience. You would think a company valued at $47 billion, occupying office towers in more than 30 countries, backed by the largest technology investment fund in history, could not be destroyed by publishing a routine financial disclosure. You would be wrong. WeWork in early 2019 was not a company in obvious trouble. WeWork in early 2019 was the most valuable startup in America. A funding round led by the Japanese conglomerate SoftBank in January of that year had set its private valuation at $47 billion. It operated more than 500 locations in over 100 cities across 33 countries. It employed roughly 12,500 people. It had received approximately $11 billion in investment from SoftBank alone, more money than almost any private company in the world had ever raised from a single backer. More than the numbers, WeWork was a cultural phenomenon. It had branded itself not as a real estate company, but as a movement. Its stated mission was to elevate the world's consciousness. It served craft beer on tap, hosted summer camps for its members, and built its offices to feel like the lobby of a boutique hotel rather than a place of work. Adam Neumann, 6'5" with hair to his shoulders, was a celebrity founder of the kind Silicon Valley produces once a decade, a man who spoke about WeWork the way prophets speak about revelations. The company had launched a residential arm called WeLive and an elementary school called WeGrow, run by Neumann's wife Rebecca. In its own filings, WeWork would claim that its potential market was worth $3 trillion, a figure it reached by counting essentially every desk worker in every city where it operated a building. It was, by the standard of private valuations, one of the great success stories of the decade. WeWork had become shorthand for a way of working and a way of living. Magazines profiled Neumann as a visionary. Competitors copied the aesthetic. The company had grown from a single floor in Manhattan to the largest private office tenant in New York City, in London, and in Washington, leasing more space in those cities than any bank or law firm. It had raised money at valuations that doubled and tripled within single years. It had convinced the most aggressive investor in the world to bet $11 billion on it. By every signal the private market produces, WeWork was winning, and winning enormously. To understand how a company that celebrated could be dismantled by its own paperwork in 6 weeks, you have to understand what WeWork actually was underneath the mission statement, and what it had always been. To find out, we have to go back to the beginning, New York City, 2010. Adam Neumann was not, by any conventional measure, a likely founder of the most valuable startup in America. He was born in Israel in 1979, raised partly on a kibbutz, and served as an officer in the Israeli Navy before moving to New York around 2001. His first 2 ventures had both failed. One sold women's shoes with collapsible heels. The other was a line of baby clothes called crawlers, padded at the knees, marketed on the claim that babies needed protection while they crawled. Neither succeeded. By the end of the decade, Neumann was a charismatic salesman with no successful company and an immigration status that depended on finding one. His partner was Miguel McKelvey, a trained architect raised by a single mother in a collective household in Oregon. In 2008, the 2 men started a business called Green Desk, an environmentally themed shared office space in Brooklyn. They sold it. And in 2010, in the wake of the global financial crisis, they used the proceeds to open the first WeWork, a single floor on Grand Street in the Soho neighborhood of Manhattan. The timing was the insight. The 2008 crash had left commercial landlords across New York with empty buildings and no tenants. At the same time, the recession had produced a generation of freelancers, contractors, and early-stage founders who needed somewhere to work that was more dignified than a coffee shop and cheaper than a traditional office lease. Newman and McKelvey saw the arbitrage. They would sign leases on cheap, empty office space, divide it into smaller units, design it beautifully, fill it with energy and beer and community, and rent it out by the desk and by the month to people who could never sign a corporate lease of their own. And the early product was genuinely good. The spaces were well designed. They felt alive. Exposed brick, glass-walled meeting rooms, communal kitchens stocked with coffee and fruit water, neon signs on the walls that said things like, "Do what you love." For a young company that could not otherwise afford a real office, a WeWork desk offered legitimacy, flexibility, and the sense of belonging to something larger than a one-person business run from a bedroom. The model solved a real problem for real people. Demand was immediate, and it grew quickly. The first Soho location filled within weeks. Newman and McKelvey opened a second, then a third, each one full almost as soon as the doors opened. Within a few years, WeWork had expanded from that single Soho floor to locations across New York, then across America, then across the world. Early venture investors recognized the momentum and funded the expansion. The firm Benchmark, one of the most respected names in venture capital, backed the company early. Newman proved to be one of the great fundraisers of his generation, a salesman who could walk into a room of skeptical investors and walk out with a check larger than the one he had asked for. He sold not square footage, but a vision of a new kind of company, a physical social network, a community that happened to occupy buildings. The pitch worked again and again. By the middle of the decade, WeWork was opening new buildings faster than almost any company in commercial real estate had ever attempted, and the valuation climbed with every new lease signed. Then, in 2007, the company met the investor who would inflate it beyond all proportion and set the conditions for its collapse. His name was Masayoshi Son, the founder of SoftBank and the architect of a $100 billion investment vehicle called the Vision Fund. It is 2017, and Masayoshi Son is touring a WeWork building. The visit, by most accounts, lasts about 12 minutes. Son does not study the financials in any depth. He is buying something other than a balance sheet. He turns to Neumann afterward and asks him a question that will define the next 2 years of the company. In a fight, Son asks, who wins, the smart guy or the crazy guy? Neumann answers, the crazy guy. Son tells him he is correct, and then tells him that he and McKelvey are not being crazy enough. Over the following 2 years, SoftBank would pour roughly $11 billion into WeWork, pushing its valuation higher with each round, encouraging Newman to expand faster, spend more, and think bigger. The man whose job was to apply discipline instead supplied fuel. This is the part that most people miss. WeWork was never a technology company. It was a real estate company, and a particular kind of real estate company with a fatal structural design hidden inside it. To understand the trap, you have to understand the mechanics of how WeWork made and lost money. When WeWork entered a building, it signed a lease with the landlord. These leases were long, typically 10 to 15 years, and they were fixed obligations. WeWork owed that rent whether or not a single member ever walked through the door. Then WeWork spent heavily renovating the space and rented it out to members on short-term agreements, often month to month, that those members could cancel at any time. On one side of the ledger sat enormous, long-term, non-negotiable liabilities. On the other side sat small, short-term, cancelable revenue. The entire company was built on that mismatch. By a strange symmetry, the company valued at $47 billion had also committed to roughly $47 billion in future lease payments. Against that mountain of obligation, it held only about $4 billion in committed revenue from members. In an expansion, the model looked like growth. In a downturn, it was a guillotine. If the economy turned and members canceled, the revenue would vanish in weeks while the leases remained for another decade. WeWork had built a business that could lose money faster the larger it became, and it was becoming larger as fast as it possibly could. There is an old danger in finance that this resembles, and it is worth naming precisely because it is the danger that destroys banks. A bank borrows short and lends long. It takes in deposits that can be withdrawn at any moment, and it lends that money out for 30-year mortgages. When confidence holds, the arrangement works. When confidence breaks and the depositors all want their money at once, the bank cannot call in its long-term loans fast enough to pay them, and it fails, no matter how sound its assets looked the week before. WeWork had built the same structure in reverse and in real estate. Its obligations were long and fixed. Its income was short and could evaporate. The company was not a technology firm, and it was not even a particularly clever real estate firm. It was a maturity mismatch with beer on tap, and a maturity mismatch is one of the oldest ways in the world to go bankrupt. WeWork also told its investors that the opportunity in front of it was almost limitless. In its filings, it claimed a total addressable market worth $3 trillion. It reached that figure by counting, as a potential customer, essentially every office worker in every city where it operated a building, whether or not that person would ever want a desk in a shared workspace. It was a number designed to make a real estate company look like a software company with the entire world as its market. The number was not a lie exactly. It was a story told in the language of spreadsheets. The actual numbers showed the truth plainly to anyone who read them. In 2017, WeWork lost $883 million on revenue of $886 million. In 2018, it lost $1.9 billion on revenue of $1.8 billion. The company was losing nearly $2 for every dollar it brought in, and the losses grew in lockstep with the revenue. There was no point on the horizon at which growth turned into profit. Growth was the thing producing the losses. To obscure this, WeWork invented an accounting measure it called community-adjusted EBITDA. A standard earnings figure removes interest, taxes, depreciation, and amortization. WeWork's version went further, stripping out marketing costs, administrative costs, and the design and construction costs of building out its spaces. After removing nearly every real expense the business incurred, WeWork could present a loss of hundreds of millions of dollars as a profit of $233 million. When the metric first appeared publicly in a 2018 bond offering, a bond analyst named Adam Cohen gave it the only assessment it deserved. He said he had never seen the phrase in his life. Here is the forensic center of the entire story. None of this was secret. SoftBank knew the losses. The board knew the lease structure. The bankers competing to take WeWork public knew the economics. The bondholders had seen community-adjusted EBITDA in 2018. The information was available, documented, and understood by every sophisticated party involved. They funded it anyway, because in the private market, a valuation is not a measurement. It is an agreement. As long as the next investor would pay a higher price, the last investor's number was real. This is the trap, and it was not WeWork's alone. It was the structure of an entire era of private capital. Every later event makes sense once you see it. The collapse was never going to come from new facts. It was going to come from a new audience. This is not a story about a fraud that was uncovered. The first warning had arrived more than a year before anyone outside finance was paying attention, and it came from the one corner of the market that is paid to be skeptical. In April 2018, WeWork went to the bond market to raise money, issuing $702 million in bonds. The bond market is not the venture market. Bond investors do not buy stories about elevating consciousness. They model cash flows, they stress test downside scenarios, and they price the risk of not being repaid. When they examined WeWork, they were not impressed. The rating agencies assigned the bonds a grade of B+, several steps into the category known as junk, debt considered speculative and risky. The bonds carried an interest rate of nearly 8%, the price a company pays when lenders doubt it. And it was in that bond prospectus that community-adjusted EBITDA made its public debut and was immediately mocked. The warning was specific, and it was early. A market built on numbers rather than narrative had looked at WeWork 16 months before the IPO and concluded it was a risky proposition, losing enormous amounts of money. The conclusion was correct. The response from WeWork and its backers was to ignore it. SoftBank kept investing. The January 2019 round raised the valuation to $47 billion. Neumann kept expanding, kept spending, and kept borrowing against his own stake. The reason the warning could be ignored was the era itself. The decade following the 2008 crisis was a period of historically low interest rates, which meant that money was cheap and investors everywhere were desperate for returns they could not find in safe assets. That desperation flowed into venture capital, and venture capital flowed into companies that promised explosive growth, profitability deferred to some distant future. SoftBank's Vision Fund alone controlled $100 billion and needed to deploy it. In an environment that awash in capital, a company did not need to make money. It needed to grow, and to tell a story compelling enough that the next investor would pay more than the last. WeWork was nearly the perfect expression of that logic. The rational short-term calculation was simple. As long as SoftBank kept writing checks, the skeptics in the bond market did not matter. The lesson the bond market offered was the correct one. The lesson WeWork drew from being able to ignore it was catastrophically wrong. But it gets worse. Because the only way to keep a company like this alive was to keep raising larger and larger sums, and the largest pool of capital left to tap was the public market. To reach it, WeWork would have to do the one thing it had never done. It would have to open its books to everyone. In August 2019, everything accelerated and entirely in the wrong direction. On August 14th, the We Company published its S-1, the prospectus required before a public offering. For the first time, the full financial and governance picture of WeWork was visible to the public, to the financial press, and to the institutional investors who would be asked to buy the shares. And the same facts that private investors had accepted for years, read by an audience that had no incentive to believe them, produced an immediate revolt. The losses were there in full, $1.9 billion gone in a single year. The lease mismatch was there. The community-adjusted EBITDA was there, and alongside the economics came the governance disclosures, each one worse than the last. Neumann held shares with 20 votes each, giving him near total control of the company, regardless of how much stock the public bought. The filing included a provision concerning his wife's role in selecting a future chief executive, effectively describing a dynasty. Neumann personally owned stakes in 4 buildings that he then leased back to WeWork, collecting rent from the company he ran. He and McKelvey had trademarked the word "we" and sold it to their own company for $5.9 million. And before asking the public to invest, Neumann had already cashed out and borrowed more than $700 million against his stake. The market's reaction was not gradual. In the months before the filing, the bankers competing for the assignment had told Neumann almost anything he wanted to hear. J.P. Morgan and Goldman Sachs, the 2 most prestigious investment banks in America, had courted the IPO aggressively, and Goldman had reportedly floated the possibility that WeWork could be worth as much as $90 billion once public. Jamie Dimon, the chief executive of J.P. Morgan, had personally cultivated Neumann for years. The bankers had every incentive to flatter, because the firm that won the listing would collect enormous fees. None of them, in the years of courtship, had forced the reckoning that the public filing forced in a single afternoon. Within days of the S-1's release, the proposed valuation began to collapse. The bankers who had floated figures as high as $60 and $90 billion now could not find buyers at 20. The number fell to 15, then toward 10. And as the financial press dug into the filing and into Neumann himself, the portrait that emerged was of a founder whose ambitions had detached from reality. He had spoken by various reported accounts of becoming the world's first trillionaire of WeWork, reaching a valuation of $10 trillion of living forever, of brokering peace in the Middle East, and of one day becoming, in some undefined sense, president of the world. These were not the statements of a man building a company that subleased office space. They were the statements of a man who had been told for years, by the most serious investors alive, that he could not be crazy enough. WeWork tried to respond. It cut Neumann's super voting power, first from 20 votes to 10. It removed the provision about his wife. Neumann returned the $5.9 million he had taken for the word "we." Each concession came a day or two after a specific press report, which made the company look reactive and exposed, a firm with no defensible position retreating one step at a time. On September 17th, the roadshow was postponed. The offering was effectively dead. Between September 22nd and 24th, the SoftBank-led board moved against the founder. On September 24th, Adam Neumann resigned as chief executive. On September 30th, WeWork formally withdrew the filing. 6 weeks after publishing the document, the company had no offering, no founder at its head, and a valuation that had fallen by more than 70%. SoftBank now faced a choice it had created for itself. It could let WeWork fail and write off the $11 billion it had already invested, or it could pour in more money to keep the company alive and protect the value of what it owned. In October 2019, it chose to double down, providing a rescue package valued at roughly $9.5 billion and taking around 80% control at a valuation below $8 billion. As part of the arrangement, Adam Neumann left with an exit package reported at up to $1.7 billion, including roughly $970 million for his shares, a $185 million consulting fee, and a $500 million line of credit. He had presided over the fastest destruction of value in startup history, and he had been paid more to leave than most founders earn in a lifetime of success. For Masayoshi Son, the man who had told Neumann to be crazier, the reckoning arrived in public. SoftBank was forced to write down the value of its WeWork investment by billions of dollars, and the conglomerate reported its first quarterly loss in 14 years, driven largely by the collapse of the company Son had championed. Son did something investors of his stature rarely do. He admitted he had been wrong. His investment judgment, he told shareholders, had been poor in many respects, and he said he was reflecting on the mistake. It was a remarkable confession from the most aggressive investor of the era, and it confirmed the central fact of the story. The people closest to WeWork, the ones who had funded it and inflated it, had always had the information. What they had lacked was the incentive to act on it until the public refused to play along. What followed was a long, quiet unraveling. The new management began selling the trophies of the boom, including Neumann's private jet, a $60 million Gulfstream the company had bought for a founder who liked to travel. By late November 2019, the company had laid off roughly 2,400 employees, about 19% of its workforce. WeGrow, the school, was shut down. WeLive, the residential experiment, was abandoned. The side ventures Neumann had launched, on the theory that WeWork was a lifestyle rather than a landlord, were quietly closed one after another. In 2021, having failed to go public in the ordinary way, WeWork finally reached the public markets through a merger with the shell company, a structure known as a SPAC, at a valuation of around $9 billion, less than a fifth of its peak. The number was meant to look like a recovery. It was a fraction of what SoftBank alone had put in. Then, the pandemic arrived and emptied offices around the world, and the demand for the flexible workspace WeWork sold collapsed almost overnight. The maturity mismatch that had always been the company's hidden flaw now did exactly what it was always going to do. Members canceled their short-term memberships while the long-term leases remained owed in full for years. The stock slid month after month. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy in New Jersey, listing roughly $18.65 billion in liabilities against $15 billion in assets. Its shares, once implied to be worth a slice of a $47 billion company, traded at around 84 cents. In June 2024, WeWork emerged from bankruptcy, having shed billions in lease obligations now owned by its creditors rather than its founders or its venture backers. And here is the detail that crystallizes the entire story. Adam Neumann, the man who had lost $40 billion of his company's value in 6 weeks, walked away a billionaire. He never returned the exit package. He kept the fortune he had extracted before the public was ever allowed to look. And in 2022, the venture firm Andreessen Horowitz invested roughly $350 million in his next venture, a residential real estate startup called Flow, valuing it at over $1 billion before it had opened a single building. It was reported to be the largest check the firm had ever written to a single founder. The man who had demonstrated, more vividly than anyone in a generation, the danger of funding a story over a business, was funded again on the strength of a story before there was any business at all. The machinery that had inflated WeWork simply reset and began again with the same man. In 2024, Neumann attempted to buy WeWork back out of bankruptcy, offering several $100 million. He was turned away. Today, WeWork still exists. It operates as a private company, owned by the creditors who took it over in bankruptcy, running a reduced portfolio of the offices it once expanded into so recklessly. At its peak, it was valued at $47 billion and employed roughly 12,500 people. The company that emerged from bankruptcy is worth a small fraction of that, and the mission to elevate the world's consciousness has been quietly retired in favor of the unglamorous business of subletting office space. Which is what WeWork always was. The most durable thing the company produced was its own cautionary tale, taught now in business schools, dramatized in books and a television series, and invoked as shorthand whenever a private valuation outruns the business beneath it. The company did not collapse because a fraud was exposed. There was no secret in the S1 that SoftBank, the bankers, and the board had not already seen and chosen to fund. Every number that destroyed WeWork in September 2019 had been true in January 2019, when the same company was worth $47 billion. The facts did not change, the audience did. A private valuation is a story that a small number of people, each holding a stake in its being true, agree to tell one another. It can survive almost indefinitely inside that closed room. WeWork's fatal error was not the lease mismatch, or the losses, or even the founder. It was the decision to carry the story out of the room where everyone was paid to believe it, and into the one place where strangers were paid to doubt.